But we are now in the process of implementing digital menu boards in our drive-thrus, powered by AI, which will enable us to do things like voice prompts, voice ordering, things like day parting, things like localizing menus so that particular products that may be more popular in one locale can be served up more often, things like upselling, you name it. Naturally, order confirmation boards to help improve order accuracy come part and parcel with all of that. But we see AI in the drive-thru as being another way to unlock throughput and capacity while simultaneously enhancing the guest experience.
Zaxbys is ready to fulfill its destiny in the chicken business. Hello, this is Jonathan Mays, editor-in-chief of Restaurant Business. And in this week's episode of A Deeper Dive, I speak with Bernard Acoca, the CEO of the fast casual chicken chain. Bernard was hired as CEO 3 years ago and was the first non-founder to lead the Atlanta-based chain. He has spent the past 3 years bunkering, using his terms, as he spent time to work to fix the brand's operations. Now he is ready to talk and has agreed to come on the podcast to detail everything that's being done at Zaxbys right now. Zaxbys has what it takes to be a major player in the chicken business, but its sales have not really reflected that more recently. System sales grew just more than 4% last year, according to Technomic. That is well below the 24% total growth for fast casual chicken chains. We talk with Bernard about why that is and exactly what's being done about it. We talk about new management, unit economics, drive-through speed, franchising, digital sales, and because it's 2025, AI. We're talking Zaxbys on A Deeper Dive, so please check it out. Okay, I am here with Bernard Acoca. Bernard, welcome to the podcast.
Thank you for having me, Jonathan. It's nice to see you.
Nice to see you, man. So what's going on at Zaxbys right now?
Wow, it's been an exciting journey. I've kind of deliberately remained in the bunker for a few years and I really haven't conducted many interviews, but now's the time, I think, for us to really tell our story, because I think we've reached this inflection point in the business where we've got something truly exciting to talk about. I joined Zaxbys in January of 2022, about a year before it was acquired by Goldman Sachs. I'm the first non-founder CEO of the company, and I was brought on board really to kind of revitalize growth in the brand. The brand was a very fortunate brand in that it had only known growth by and large in its 30 plus years of existence. I would say that in the last 5 years, from about 2017 up until the time that I joined, new unit growth was actually decelerating and going in the wrong direction. And I think that's one of the reasons why Goldman Sachs had kind of stepped in and decided to acquire it, because they saw a lot of opportunity to reverse that trend. And so I was brought on board to really take a brand, an iconic brand, a brand that had been, like I said, very, very successful in its southeastern core, and really grow it and make it a coast-to-coast domestic brand. And that's what we've been working on ever since I've arrived.
Right. My, my perception, and you can correct me if I'm wrong or debate, whatever. My perception has always been that Zaxbys has more potential than it's realized. It has all the makings of a restaurant chain that should be amazingly successful. This hasn't, certainly in the past, several years, hasn't necessarily met what my expectations would be, because the food is, for one thing, it's delicious.
Appreciate saying that. I couldn't agree with you more. I mean, this is a brand that arguably operates in the hottest category in all of QSR, which is boneless fried chicken. It's a brand which I'm very proud to say will this fall attain its 1,000 unit mark. And it's a brand that we've been growing ever since I've arrived. As I mentioned at the start of my comments, when I got here, new unit growth was less than 1% annually, net new unit growth. This year we'll hover somewhere between, let's call it 5 to 6%, depending on where we finish up the year. But we see and have aspirations to grow it at a much more accelerated pace. We see this brand being able to get to eventually 10% annualized new unit growth. We've been steadily, with each year that I've been here, getting closer and closer to that number. But really the way we've done that is, going back and ensuring that we've got the foundational elements in place to scale this brand successfully the right way. And I think that was one of the big things that was missing when I joined the company certainly a few years before I joined, was the founders had done a phenomenal job growing this brand for its 30 plus year history. But I think, hadn't necessarily made the right foundational investments to continue to scale it beyond that point.
Mm-hmm. First off, before I go any further, I have to say the banana pudding shake, I would commit a serious crime to eat that right now. Anyway, so, but one thing I'll say is that a lot in Zaxby's defense, like I think the number of people on this planet that can start a restaurant chain and run it for a certain period of time, who can both start a restaurant chain and manage its growth, is very teeny. Very, very few
Yeah.
people can actually accomplish both of those goals. They're usually two very, very different types of people. There are people that can manage and operate and things like that, and there are people that are founders and whatever. And maybe, most brands that have been successful like that, like say Jersey Mike's, for instance, has run for decades by a founder, but there's always somebody that's operating the day to day and stuff like that. So it's a little hard, I think, to do both.
Yeah, you're absolutely right. And, like I said, our two founders, Zach McElroy and Tony Townley, created something truly amazing here that I feel very blessed to have inherited. However, the world also changed in the last few years while they were at the helm right before they sold it to Goldman. I mean, naturally, inflationary headwinds facing the industry last 5 years, likes, many brands have never seen before. We had the onslaught and the advent of the pandemic, quite frankly, that changed the nature of how a lot of restaurant brands operate. So, some of us would spend, our professional experience having worked at larger brands, global brands, et cetera, I've seen what it takes to grow those brands, not just domestically, but internationally. And so, with my arrival, we brought on board perhaps a bit more seasoned executive team, individuals who've worked at blue chip restaurant companies and have done it elsewhere. And, for the last 3+ years, I'll celebrate my 4th-year anniversary this January. We've been implementing and haven't changed course our Grow to Win plan, which is made up of, 5 strategic pillars. And those 5 strategic pillars have served us very, very well. The first one is, and they go in a very deliberate order. The first one was to reduce our cost structure without compromising our quality. And one of the things I encountered upon joining the brand was delicious food, as you mentioned. We have a wide-ranging menu that caters to a variety of different tastes, but our COGS, when I got here, were entirely way too high for a variety of different reasons. Our procurement strategies weren't right. We weren't hedging. We didn't diversify our supplier base enough. We were very reactive to prices in the marketplaces being proactive, et cetera, et cetera. So our COGS were just way too high. Fast forward to today, we've managed to lower our COGS by 7 percentage points, see a lot of opportunity to lower them even further over the next few years. And so we really had to get that down to get our unit economics right. Our unit economics were good. They are far better today, and we still see opportunity ahead to get them to be what I consider to be best in class cash on cash returns for our franchisees. The second strategic pillar is what I termed moving together as one with speed and purpose. And there are 2 operative words there, speed and purpose. On the speed front, 70% of the volume that we do is done through the drive-thru at Zaxbys. But when I got here, our drive-thru speed of service times were entirely too slow, especially relative to our competitive peers. And so we put a full court press and have ever since against getting faster in the drive-thru. And I'm very proud to say through, whether it's using and leveraging, tablet and order paying technology during peak hours in the drive-thru, or better drive-thru station ergonomics, better training, et cetera. Now, actually, the usage of AI and cameras in the drive-thru, which we've implemented recently, we've managed to improve our speed of service in the drive-thru by 20%. So our throughput capacity there has improved substantially, and that has yielded much more, a better overall guest experience, and naturally great sales that follow as a result. The other word that comes in that sentence, moving together as one with speed and purpose, is purpose. And there, when I joined, we realized that, we've got this great brand, but not all our franchisees are necessarily adhering to our operational standards as well as they could be. And so now through an operations scorecard, through better enforcement, through better shoulder to shoulder training with our franchisees, we are moving the system together as one and getting people to adhere to our brand standards and operating standards a lot better than they ever historically have, which is why things like order accuracy, a metric that we weren't necessarily great at with 12 different sauces in our arsenal, has improved by 12%. The third, I should say, strategic pillar in the Grow to Win plan is around really the digitization of our business. And I know you hear that quite often, but we wanted to make the guest experience easier and more personalized through the digitization of our business. And, we made those investments in the infrastructure to do that. And give you like kind of some data points around that. When I joined, digital was only 8% of our total sales. Fast forward to today, and they are a little north of 20%. We didn't have a loyalty program to speak of at the start of January of 22. Fast forward to today, and we have one that's approaching 7 million members, and it's underpinned by a customer data platform. We see this program as being really the crux of how we envision going to market in the future. And so very, very excited about the progress we've made there. But the fourth was around the brand. And it was what I called being a desirable island that stands out in a sea of sameness. And so the great thing about being in this category, which I said is arguably the hottest in all of QSR, is that everyone wants to enter it, from regional upstarts to the larger entrenched chains doubling down on the business. So how do you differentiate yourself when you've got so many people entering it and so many people already in it? And we decided that we really needed to articulate with clarity and precision what our brand stood for. And we did that by codifying our brand architecture and encapsulating it in a brand book, literally this book right here. Everything that the brand stands for, what our key differentiators are, what our unique reason for existence in the world is now captured in this book. We've trained our entire system on it. And now we can operate with crystal clarity when we go to market and really communicating to the consumer what we do better than anyone else. And then the last and final strategic pillar in our Grow to Win plan, which has really driven our results, is what I call sharing Zaxbys magic with more and more people. And that's getting us back to that new unit growth I talked about earlier. And to do that, we needed to do two key things. One, we needed to actually take a hard look at the building that we were erecting in the markets in which we do business. We only had one building in January of 22, a freestanding 3,000 square foot drive-thru unit, which was quite frankly too expensive. Fast forward to today, we've now got 6 different building types to offer our franchisees, anything from a 56-seater to a 30-seater to an inline restaurant to an end cap restaurant, you name it. And those buildings are anywhere between 30 to 75% less expensive than they once were. So that has enabled our existing franchisees to want to build, new franchisees to get into the Zaxbys proposition a lot easier. And as a result, we are starting to attract more and more new franchisees to the Zaxbys brand than we ever have before. So that's the Grow to Win plan in a nutshell.
All right, lots to unpack there. Let's start with the drive-through stuff.
Yep.
I technically write about fast food, and drive-through is something that's a notable thing. But you mentioned, so I mean, I guess first off, I mean, improving speed seems to be one of the. It's not easy to do, but like if you're a fast food brand right now and you're looking for a surefire way to improve sales or improve traffic, improving speed in the drive-through. Throughput in the drive-through, particularly at peak times, seems to be like the absolute, maybe one of the first absolute things you should do. Is that fair to say?
Completely, especially when you're driving as much volume through that channel as we are.
Yeah, but now you mentioned AI. What is AI doing for you in the drive-through right now?
So right now, we're actually leveraging a company called Berry AI. And through camera technology and the use of AI to analyze the data that's coming through those cameras, we're able to pinpoint location by location where bottlenecks in the end-to-end drive-through experience occurs so that our teams can then figure out how to best address where those bottlenecks are occurring and quite honestly, put corrective action towards fixing it. And so that's one way that today that the system is applying and leveraging AI technology to improve throughput. Another area where we're making an investment, we're currently in the process of testing this in all our company restaurants. We're about 85% franchise, 15% company owned. And our company, and we hope to actually exit this test successfully, which it looks like we will, to roll this out to the rest of the system. But we are now in the process of implementing digital menu boards in our drive-thrus, powered by AI, which will enable us to do things like voice prompts, voice ordering, things like day parting, things like localizing menus so that particular products that may be more popular in one locale can be served up more often, things like upselling, you name it. Naturally, order confirmation boards to help improve order accuracy come part and parcel with all of that. But we see AI in the drive-thru as being another way to unlock throughput and capacity while simultaneously enhancing the guest experience.
Mm-hmm. Have you done anything to increase like labor inside the stores or anything like that during peak hours? Anything along those lines? That usually helps with speed.
We've had to, as part of the overall digital experience, we've had to deploy a little bit more labor here and there depending on the channel that we're looking at. So I'll give you an example. One of the things that we didn't really have rolled out, on a wide scale basis when I joined was curbside pickup. Curbside pickup is an option that you can choose when engaging with our digital app. In situations like that, more labor was required. Another example in the drive-thru, naturally during peak hours, when you're putting someone out there with an order-taking tablet in the drive-thru, in order to expedite throughput and take payment in the drive-thru, naturally a little bit more labor during peak hours is required there. But the great news about all those things is that the return on investment for that labor is there. So.
Mm-hmm. So what if like on the unit economics, so you've focused a lot on unit economics. Obviously it's a super important element in any sort of franchise. Actually, it's important it doesn't matter what the type of concept. If your unit economics are good, you'll be able to expand. If they're not, you won't. That's not rocket surgery, but what kind of things have you done to improve the unit economics for the operators?
Well, I mentioned a few. One,
Yeah.
reducing the COGS by 7
Right.
points.
Yeah.
2, reducing the cost of the building. 3, and nothing forgives like growing top line sales. Next year, when I got here, our brand was driving $2.6 million in AUV in the 22 fiscal year. Next year, we're on track to hit $3 million AUVs. So naturally, when you're lowering your COGS, you're lowering your building costs, increasing your AUVs. And there are a few franchise concepts that are doing, $3 million plus AUVs for a 2-day part business. You're flowing a lot more money to your franchisees' bottom line.
Mm-hmm. Yeah, no, not a lot of 3 million AUV fast casual chains. It pretty small number. So, like, how are you able to reduce COGS by 7 points?
So a few things. I think there was a lot of low-hanging fruit when I got here. I think we really needed to professionalize our supply chain and procurement department. And through some great leadership that we have in place there, we started to get into hedging and long-term contracts that we weren't currently doing. We started to diversify our chicken supply base and the suppliers who support us, and now have more suppliers than we ever have had before to meet the demand, but also really to ensure that we're getting the best possible pricing from everyone. And quite frankly, the key thing that we did was we took a lot of the unpredictability out of chicken procurement that was once there. And that's what our franchisees are looking for more than anything else, is they want stability and predictability in their business. So through our long-term contracts, we kind of have like floor and ceilings that we've set. So sometimes we may pay a little bit more, sometimes we may pay less, but what we do know is going forward, we shouldn't be greatly surprised by what the price of chicken is because of the contracts that we currently have in place. And that first year I was here, we were, caught off guard, too surprised, and having to contend with that. And I promised myself that we would never be put in that situation again.
Right, right. Yeah, that can be challenging. The one thing that we haven't really talked about in any detail, seems like you made a lot of changes to the management team. I assume that was one of the first things that you've done, wasn't it?
Yeah, year one, it was about getting the right executive team in place because everything starts with the people leaders that you have running your business. So I was very, very fortunate that people got as excited as I was about what Zaxbys was and what Zaxbys could be. So we brought on board in year one a new chief marketing officer who came to us over from Arby's. We brought on board a new chief operating officer who had 30 plus years at McDonald's. We brought on board a new chief development officer who had worked at Domino's and Dairy Queen and Orange Theory Fitness. We brought on board a new chief technology officer, a new chief financial officer. Just a year ago, I had brought on a new chief digital officer. So a lot of new people to lead the business. The one thing that they all share in common that was an absolute requirement of mine was that they all came from world-class brands, big blue chip companies, because we have aspirations to be a lot bigger than we are. And I wanted people in place that had seen it and done it before.
Hmm. That's an awful lot of change for a company that has been, basically been operated by one of the founders pretty much its entire history. And you come in, bring an entirely new management team and make all sorts of changes. This after a sale of the company. How do you sort of do all of that and then just kind of while keeping sort of, I guess, what made the brand great over time and just to and then I guess just sort of maintain corporate morale?
I think it's a great question. And it's probably the one that was the most difficult of any challenge I had as a CEO, because I think the one amazing thing, well, there are a lot of amazing things, but the one thing that stands out head and shoulders above the rest as to what Zach and Tony really built here was an amazing people first, servant leader led culture. And that really permeated not just the support center here, but really the franchisee community. I mean, the one thing that marks Zaxby's more than anything else are really the harmonious relationships we've had with our franchisees for 30 plus years, because the way the brand started was that Zach started franchising to family members and friends of friends and friends of family members, et cetera. So these kind of concentric circles that were ever widening in the brand, and many of those franchisees are still with us today. So that doesn't happen by chance. It happens when you've got a really great culture in place. So I had to walk this very, very fine line between preserving that, making sure that we maintained and actually enhanced our people first culture, while also building a business case for change and explaining to people why change was absolutely critical for us to enter the next chapter of Zaxby's success. It's probably the most difficult job I had to achieve as a CEO. But I think it all starts with going back and ensuring that you've got the right values in place and making sure that every one of your business decisions are done through the lens of those values. And the values of the organization haven't fundamentally changed over the course of time. And that's the thing that, we treat as sacrosanct and want to preserve.
Yeah, yeah. One of the more challenging situations in any business period, but certainly in the restaurant industry, is going through ownership and management changes. And I can tell you time and again that is probably it's really the riskiest period in any sort of business. A lot of restaurant chains went from being amazing growth stories to being not amazing growth stories because of those situations. And it can be a really, really difficult period. I don't think that people fully appreciate it. There's a lot of change on people,
I think
especially.
the acid test for us in that really was, and we had a lot of trepidation around this. We had actually moved our headquarters from Athens, where it had been for 30 plus years, to Atlanta. And we did that because naturally we wanted to, given where we were in our growth phase of things, and given that we were growing so rapidly, wanted to have access to a larger talent pool. Logistically, it was a lot easier to get in and out of Atlanta for both franchisee prospects and our own support center team members. But we were very concerned that when we were making the move, that we were going to lose some people, quite a few people along the way. As a matter of fact, we were told by some consultants that we should be prepared to lose about 30 to 40%, which is typically the norm. Very, very proud to say that because of the culture that we put in place, because of how we chose to handle it and the transparency with which we handled it with our people, we really lost less than 15%. So people were really signed on to continue being on the journey with us, because you really want that admixture of people that have been here a long time, that know the brand, that serve as the continuity thread of the brand, and complement that with people that from the outside that have perhaps a bit of a broader frame of reference. And when you bring those two people together, those two groups together, that's when the magic in a brand really happens.
Mm-hmm. So you've got 6 prototypes now?
We've got 6 different prototypes now to meet a variety of different real estate needs, variety of different DMA needs. So for instance, we just signed a deal to expand in the New York metropolitan area in the 5 boroughs, 2 different franchisee groups there. We now have an inline restaurant that can accommodate the real estate requirements for that type of DMA. We wouldn't have had that 6 years ago. So that's a good example of the need to create that in order to facilitate our growth.
You didn't have an inline prototype before?
We had one that we tested unsuccessfully. This predates me. And we had done it in our hometown at the time of Athens, Georgia. But one of the key things I think we perhaps weren't ready for when we did it at the time was we didn't have a strong, vibrant digital third-party delivery off-premise business, which so often is a prerequisite for inline business to successfully work. And so now that, our business is slightly north of 20% digital and growing, we think we've kind of stumbled on the right formula to make those inlines work on a go-forward basis.
Right. But you need the inline if you're going to go to a place like New York.
Absolutely.
You can't really. You can some places with a drive-through for sure.
It's my hometown. I know it all too well.
Yeah. It's a little bit of a prerequisite, but it can be a really good market to go into for brand recognition and stuff like that. So, but fascinating. But the different prototypes. I mean, you expect that to help fuel more unit growth and things of that nature?
Yeah, I think the one that we have a lot of excitement for is one that we're starting to roll out at a pretty rapid clip right now, which is before I got here, I think our restaurants were slightly too large. The default unit was like a 56-seater because our dine-in business was really where the brand for many years put the focus. It's not that we're taking our focus off of that, but the world really has changed. And so we think our sweet spot is a 30-seat restaurant that can drive comparable AUVs to what a 56-seater can drive. And we're starting to prove that out.
Really? Yeah. Yeah, you still need the seats, but probably not as many of them.
That's correct.
Mm-hmm. And franchisees are signing up for these right now?
They are. Now, there'll be a need for larger restaurants here or there. You've got an off-highway location. You may want larger seats. But I think what we're starting to find is that this 30-seater really meets a need that can balance build cost with driving the kind of higher AUVs we're accustomed to.
Right. Really cool. One last question, sir, before we go. Now you've gotten all of these you got new management in place, you got the prototypes in place, you've got the digital sales where you want them to be. Where does Zaxbys go in the next couple of years?
Well, like I said, we are super excited about growing this brand and really being a coast-to-coast brand eventually. And who knows, maybe down the road after that internationally. And we've made a tremendous amount of progress in doing that. Like I said, we'll celebrate our 1,000th store opening. We're about to open this month, for instance, our first restaurants in Phoenix, Arizona. Very, very excited about that. We just recently opened up several restaurants in Las Vegas to great success. So we're making our way out to West Coast eventually. We're doing so thoughtfully by ensuring that we've got the right franchisee partners along the way. I think the thing that gets us really, really excited is that we have laid the foundation and the underpinnings to scale this brand and get us competing on a coast-to-coast basis like some of our key competitors are.
All right, superb. And thank you so much for joining us this week on the podcast, Bernard.
So much for having me, Jonathan. I appreciate it.
And that should do it for this week's episode of A Deeper Dive, which was edited, as always, by Spoons. Artwork by Nico Hines. You may find this and other episodes of the podcast on our website at www.restaurantbusinessonline.com/article/deeper-dive. But please subscribe on Apple Podcasts or Spotify. I'm Jonathan Mays, your host, podcast producer, and the editor-in-chief of Restaurant Business. Thank you for listening.